Hello, I'm Sam Benstead. Kyle is out of office, so I'm stepping in for another week to host On the Money, the weekly look at how to get the best out of your savings and investments. This week we are discussing active ETFs, a relatively new type of exchange traded fund that allows instant access to actively managed portfolios. With me to discuss this product is Tom Bailey, who is the head of research at ETF firm HANetf. Tom, thank you so much for coming on the podcast. We're here to talk about exchange traded funds, ETFs. These are now quite a normal investment vehicle, but they haven't always been. So can you please talk me through the history of ETFs and how we got to where we are today?
Thanks, Sam. Thanks for having me. Pleased to be here. We can go right back to the start. I think it's kind of illustrative of the changes we've seen in ETFs. So the origins of ETFs actually lie in the 1987 market crash, Black Wednesday. And the report the SEC published after that crash essentially said, it would have been great if there was a tool for investors to buy the entire market intraday, which could have stemmed that big drawdown. Now, a guy called Nathan Moss noticed that in the report. Several people did, but Nathan Moss did, and kind of inspired him to think about how he could create that tool. Because obviously, back then there wasn't an ETF. There wasn't a way you could buy the entire market intraday in the middle of the trading hours, right? You could do an index fund, but obviously you only get that only deals at the end of the day. And so with that in mind of how to create that, he set about trying to create it. And the combination of that is basically in 1993, the creation of SPDR, SPY, the biggest ETF in the world, most of the time. Sometimes the Vanguard S&P 500 tracker takes over, but this is the biggest ETF in the world, the oldest ETF in the world. And so that's the first ETF. And I think, the launch of that ETF, obviously it was built to track the entire market and be a tool to buy the entire market, S&P 500 in particular. And I think at the same time as you saw kind of investors increasingly aware of that tool, start to use it and aware of ETFs themselves, was around the same time that you also saw this growth of passive investment. So the two that's different, passive and ETFs are not the same thing, but the two kind of grew up together and came to prominence together. So I think that what that created in the mind of many investors was this kind of synonym between passive ETF, which you kind of still see today. But, within 10 years of launch of that, you saw the first gold ETF, or ETC, technically be launched. Actually, our co-CEO, Nick Benkowski, essentially invented the first gold ETC back in the early 2000s. And so there was this expansion of kind of what you can actually do inside an ETF. It doesn't just have to be, S&P 500. Instead of that's tracking the price of gold. And then in the 2000s, you also saw, 2008, you saw the first active ETF launch in the US. And then you saw the kind of new products emerge, kind of utilizing kind of research from, French and Fama around different factors and doing these smart beta ETFs with a kind of a tilt towards value or growth or quality, etc. And then they kind of took on kind of interest in the 2010s. And at the same time, then you saw this kind of approach towards thematic in terms of maybe you screen the stocks for revenue exposure to certain areas to try and capture these kind of broad themes. And so you saw that kind of expansion of the use of ETF. And so as I mentioned, the active ETF has been around since 2008. It's the first active ETF launched in the US, but it's really been probably the last 6 years, I'd say, that we've seen a strong, real kind of substantial growth in active ETFs in particular. In the US, it's coming to Europe. But obviously in Europe, I think we're usually always around 5 to 10 years behind the US on these trends. But in the US, so last year in the US, 80% of new ETFs that launched were active. Essentially, no one is launching the mutual fund anymore in the US. The default wrapper has increasingly become the ETF itself. And then, we start to see that trend come towards Europe. So last year in Europe, active ETF AUM in aggregate grew by 68%. So we're kind of seeing strong movement there, but at the same time, it's still relatively early days for Europe. So something like 2.6% of all ETF AUM in Europe is an active ETF. So early days, but the active ETF is kind of increasing the game in dominance.
And before we go a bit deeper on active ETFs, can you just explain to me how ETFs work? How through one transaction you can accurately own an underlying basket of shares and you're paying the right price for them?
Yeah, so it's a good way to explain active ETFs, right? Because you kind of explain the mechanism and then kind of where active is slightly different. So if you take a conventional ETF, obviously you have an index, right? Just say FTSE 100, and then obviously the ETF, the structure, the fund wrapper will buy those stocks in proportion to that. You have a portfolio manager to do that. And then obviously the ETF issuer will have shares issued against the ETF, which investors can buy. So those shares in ETF trade on the exchange throughout the day, so London Stock Exchange or New York Stock Exchange. And then the investor obviously can buy them through a platform like II and throughout the day. Now, obviously, that sounds like an investment trust, right? Because that's also what an investment trust can do. But the key difference then with an ETF is the creation redemption process. And this is what keeps the price and the net asset value of the ETF in line. So essentially the price of the shares of the ETF in proportion to the value of the underlying stocks. Because obviously if listeners are familiar with, say, an investment trust, it obviously trades sometimes at a premium or a discount. So that's the kind of issue the ETF had to overcome or basically to come into existence, and how you can do that, how you can have that daily trading, intraday trading on the exchange without having big premiums or discounts emerge. And the way that's done is essentially an ecosystem the ETF kind of industry has. And the key part of that is what are called the authorised participants. So they carry out what's called the creation redemption process. So we take that basket of stocks, say there's strong buying for it, a lot of investors want it, then you'll start to see, like with an investment trust, a premium emerge, right? So the share price will be slightly ahead of the net asset value. Now, rather than just letting that sit there, as soon as that kind of starts to emerge in a notable way, these authorized participants, people like Jane Street, flow traders, some of this you might have heard of, they will see an opportunity there. So they'll come in and then they'll see that premium. So they'll buy the underlying basket of stocks in proportion to what the ETF holds. Then they'll come to the ETF issuer, hand over those stocks to us. In exchange, we'll give them shares, and then they can then sell those shares onto the market, and that will bring down the premium. Conversely, if a lot of investors are selling the ETF, they don't want the ETF anymore, or at least a notable number don't want the ETF anymore, then you might see it start to trade at a discount. So the price of the shares of the ETF at discount to the net asset value of the underlying stocks. And so that will obviously then see the APs come in as well, see an opportunity. They'll buy the shares in the ETF, the ETF itself, and then they'll exchange them with the ETF issuer for those underlying stocks. So the AP there is kind of making a kind of a small profit arbitrage. Obviously, to do this at massive scale, but that's kind of what keeps that price and net asset value in line. Now, when it comes to an active ETF, the only difference really is that first step, the security selection. So go back to what I originally said in terms of we take the FTSE 100, the portfolio manager is buying those stocks in proportion to the FTSE 100. Instead of doing that, the portfolio manager instead is like your typical portfolio manager for an investment trust or a mutual fund or an OIC, who is basically buying those stocks and weighting those stocks in accordance to obviously what he believes has potential to provide outperformance to whatever his benchmark is.
The first I heard of active ETFs was in early 2020 when Cathie Wood's ARK innovation was all in the media. Everybody followed what she was investing in. And this was an ETF product, but actually tracked the positions of an active fund manager. It was often compared to Scottish Mortgage in the UK in terms of what it invested in. But what do active ETFs look like now in the UK? What's on the market and how are we defining an active ETF?
Yeah, I mean, so if you look at data providers, you see discrepancies sometimes in numbers because of different definitions. But we don't, HANetf, we don't have a kind of a strict definition, so to speak. Historically, you've seen these kind of benchmark aware products where, and I think this is kind of indicative of the early days of active ETFs, where there's kind of some attempt to outperform the benchmark, but kind of hugging very close to the benchmark. Not the kind of, when people talk about, closet trackers in terms of it is very transparent. This is what they're doing. They're trying to add a bit of outperformance. And I think that reflected kind of just the early days of the active ETF market. And there's been some demand for that. But I think now what you're getting is quite a change in approach. So what we're instead seeing is kind of your more kind of high conviction active strategies come to market. So obviously you mentioned Cathie Wood in the US. That's obviously a very high conviction fund, for better or worse. But if we kind of look at who's kind of entered the market recently, so we launched an ETF with Guinness, by no means a kind of shy active kind of fund house of high conviction. So we launched an ETF with them last year, as well as Jupiter. So what we're seeing, I think, is a lot of the traditional fund managers kind of realize that the ETF space is something to look at now and to add ETF to their kind of distribution tools.
And if you had the option of an ETF of an active product or an open-ended fund of the same active product, same management team, what would be the advantages and disadvantages of choosing the ETF over the open-ended fund?
So, one of the key advantages is, so it's a very strange kind of mutual fund structure. I think it's quite archaic in many ways, right? What else do you buy where you don't actually know the price you're going to end up transacting at? It's hard to think of anything else in the world you do that at, at least for consumer, on a consumer basis, right? But that is the case with mutual fund, right? You if you buy at 12 o'clock, you're getting the price at the close of market. So you don't actually know what price you're buying at. Now, not all investors necessarily care about this, but I think it's kind of, it's a strange, archaic structure in that way. And I think that's a kind of clear advantage is the price you're buying at. There might only be small discrepancies, but in periods of volatility, it might make a difference, right? So that's kind of one. And the other one is, the cost structure, not the fee, because the fees obviously, can vary, but more the cost structure. And so in this, you can point this as a upside or a downside to ETFs, or one in the ledger for ETFs, one in the ledger for mutual funds. But if you take an ETF, right, or if you take a mutual fund, when someone buys into that mutual fund, the cost of the portfolio manager buying the stocks in proportion to kind of what he wants for his allocation is borne by all the investors in it. Now, if you're an existing investor, that's detracting from your performance, right? Because you're paying for that transaction cost inside the wrapper. With an ETF, that's not the case. That transaction takes place outside. It's the APs who come along, provide the shares for the ETF. So you're not getting that kind of shared cost of maintaining the portfolio in that same way. But what it does mean, because it transacts on an exchange, there is a spread to buy the ETF, right? So, if you look on II, you'll see the bid-ask spread on your screen. So you are paying that spread potentially. Now, obviously, all ETF companies work to kind of minimize that spread, but sometimes it's a function of the kind of liquidity of those underlying stocks. So it is a cost that investors pay. But our view would be that, it's a fairer cost structure. So if you want to buy into the ETF, you want to sell the ETF, then you obviously eat the spread. That's a cost that you bear. The other investors inside the ETF are not affected by your decision making. Whereas with a mutual fund, they are affected by the decision making of other investors. So we'd say, you can look at it either way, but we think it's a fairer cost structure.
You mentioned you partnered with Jupiter. That was on a fixed income ETF, wasn't it? So how does that work when buying bonds? Is that a different process to equities?
Not really. It's still the portfolio manager, the way it would for in a mutual fund, kind of buy those bonds. Doesn't really function any differently than you expect, other than in terms of difference in terms of, buying a bond versus buying equities.
And what happens when an active ETF becomes too small or too large? When looking at open-ended funds, they often put limits on the size of portfolios, which is the fund manager saying, actually, we can effectively manage this strategy up to a certain point where we might become too large to buy what we really want to buy. So what happens with ETFs if they become too large or too small?
Yeah, I mean, so the first, if an ETF is too small, like with all funds, if the economics aren't there for an asset manager to continue to run it, then obviously they'll look at potentially closing that fund. That's kind of for all funds. Essentially, asset managers are not there to just provide funds for no reason. It has to kind of have a economic rationale for their business, right? In terms of the size, that's a nice problem to have. It's kind of not an issue. Anyone, in terms of, if you look at, active ETFs are 2% of ETF AUM in Europe right now. It's not necessarily a problem yet, but it's obviously something to keep in mind, right? That if what we think is the case, that ETFs will become increasingly the default wrapper, then it's going to be something that will be confronted at some point. So, with a mutual fund or an OIC, etc., you can gate the product to new money, right? And that's how you deal with that size. With ETFs right now, obviously that relies. So one aspect is, the fund itself would have to be very big, and then also big in proportion to, say, the liquidity or size of the underlying stocks, right? That's why you do it. So it's not, again, most active ETFs you're seeing now are still relatively small and also still investing in relatively liquid strategies. But in the future, essentially what you do is, rather than, with a mutual fund or an OIC, the asset manager themselves closes new flows because they take the flows themselves. You subscribe to the asset manager themselves. Obviously, as I described, you have this whole authorized participant creation redemption process. So instead, you'd gate the you'd essentially tell the APs in so many words to stop doing new creates on the product. The result of that would be the ETF starts to trade at a premium. So in some ways, it would start to look like an investment trust in that regard, but that would stop new money coming in. But what it wouldn't do in terms of mutual fund, if you stop new money coming in, is obviously no one can buy it anymore. In ETFs, keep in mind there's a primary market, which is that whole AP process, and then there's a secondary market, and these are just shares trading on an exchange. So you would essentially close the creation in the primary market, and then it would go to a premium. Not ideal for an ETF, because that's obviously what we kind of want an ETF to do, is to obviously trade in line with its net asset value and not be at a premium or a discount. But that's what you would essentially do. And then investors can then buy and sell those shares on the exchange. So, investors can sell at a premium into the market if there's a counterparty who wants to buy that fund at a premium still, if that's so as they wish. It essentially would look like an investment trust. So it's not a insurmountable issue. It's something that would, in theory, work very seamlessly. Whether or not we'll kind of see other approaches to that as it starts to become an issue, I think the ETF industry is very creative, and their ability to kind of consider how to make this work the best and trying to keep what everyone wants to do, keep the price and NAV in line. But if you did need to gate it, at least gate inflows or outflows, you could do so.
And have there been examples in the past where you've seen problems with the valuation of ETFs, perhaps during a market crisis where lots of people want to take money out, or a hugely successful launch where lots of money is flowing in? Have there been issues finding a real market price for the underlying assets?
Not in terms of at a launch with new money coming in. There's some interesting examples of ETFs kind of surviving through market volatility. So a good example would be when the Greek stock market closed. Obviously, there was ETFs tracking Greek Greek stocks. What a lot of the APs and the market makers in the ETF ecosystem do is they're always trying to determine the price also through correlation of other assets. So obviously, with the exchange closed, those stocks couldn't trade. But the ETF, obviously, if that ETF is listed on the London Stock Exchange, it's still trading, but you don't know what the value of what's underlying is. But using correlations of other asset classes, they could work it out roughly. And when the exchange in Athens reopened, then you did see the price had tracked relatively well. Another example, though, would be, say, during COVID, when you saw like that real volatility in the US bond market. You saw some of the fixed income products in the US kind of ETFs kind of get dislocated on price and NAV. And, again, no one wants price and NAV to diverge. That's the whole point of the ETF. But when you consider, with the kind of, there was illiquidity in the bond market, right? And then lots of people wanted to redeem out of their bond fund, be it ETFs or mutual funds. Now, if you took the ETF version, what that essentially meant was that it ended up trading on a big discount, because it couldn't price couldn't come back down in line of the underlying, because no one knew what the price was. So trading at a discount. But we'd say that comes back to the fairer cost structure. So if you take in a kind of similar scenario with a mutual fund, essentially you're getting people coming to redeem out of a mutual fund, right? The fund manager is going to sell the parts of the market which are not gummed up, which are liquid, leaving those inside it with being stuck with basically the rest of the market, which they can't sell. That creates a bit of a bank run dynamic, right? Because even if you weren't planning to sell, you didn't need that liquidity to sell out of your bond fund. You're then incentivized to do so, so you're not the last one holding basically the basket of stocks at the end, or bonds rather, which everyone was kind of, that you're not able to sell. Whereas with the ETF, what it meant was, if you really needed to sell now, you would just take that hit yourself in terms of the basically the difference between price and net asset value. So, I think ETFs are quite a resilient tool in that regard, in terms of kind of what they offer. And that's had kind of the two layers, being the primary market and the secondary market.
Let's talk about the range of active ETFs that you can buy. We've spoken about pure actively managed funds where a stock picker picks their basket, which I think is going to outperform. But there's other active ETFs, aren't there? Thematic ETFs might be categorized in this bucket. Can you just explain what those are?
I'd say if you take, say, thematic ETFs, right, because of this historic kind of focus on using index-based products for ETFs, index strategies for ETFs, a lot of the thematics in the ETF world are index-based, right? So they'll construct rules around revenue exposure or scanning for kind of IP disclosures to try and fit stocks in that kind of match the theme to provide exposure to. But there's no reason why an active manager can't do that as well, right? Because if you look at, say, the mutual fund world, there is a lot of actively managed thematic products out there, right? And so I think, so are thematics active or passive? Obviously, how they're used, it's an active bet. You think, say the defense sector is positive. You want to overweight that in your portfolio. That's the investor being active. But if it tracks an index, that's kind of less active in that sense. But at the same time, there's rules written. You make a choice that, actually to be included in this ETF, a stock must have 50% exposure plus revenue to defense. That's obviously kind of moving away from a market neutral position. So there's less active. But what we're seeing too is kind of the actual active in terms of a portfolio manager who says, so for example, our Guinness product portfolio manager who says, I know the ins and outs of sustainable energy stocks and providing that exposure through their active management skill. So you kind of both, I think there's a place for both. And essentially what you're seeing, I think, is kind of some of the strategies which would have been in an investment trust, OEIC, etc., are just being put into an ETF as well.
And the other area, which I think is quite interesting, is what you might describe as smart beta, where there are set rules, not on the themes that company is in, but on characteristics around the companies, be those, value measures or growth measures or dividend measures. So you actually build a portfolio which allows you to do something a bit different than the underlying index. Would those be considered active ETFs too?
I personally wouldn't consider active because I think, as I described, constructing those rules, there's an element of kind of activeness in terms of you moving away from what is a neutral kind of benchmark market. But at the same, and also how that's implemented as an active choice of the investor. Obviously, do they want 2% in this product, 5% in this? Is obviously active management within a portfolio. I wouldn't necessarily describe those products as active because I think that kind of muddies the waters a bit for what we are seeing, which is the actual active products. With the smart beta question, they were quite popular around 10, 15 years ago, and dividend products, I think, are still very popular. But I think one of the issues has been is that while as we have all the historic data on value stocks outperforming other stocks, it's not actually been the case. And there's only so long, an ETF which doesn't provide performance will kind of continue to track assets into it. So, and a lot of investors are not necessarily going to be buying what's the appeal of a smart beta growth product when obviously if you look at the market is obviously for the last 10 years, it's been very heavily skewed towards growth stocks anyway. So it was a value, obviously, was kind of the question, and that kind of reversion to values outperformance, which has obviously happened periodically over the last 10 years, but kind of small blips. So I think a lot of investors kind of have moved away from that smart beta style products for now. But, once you get, the market is changing. Obviously, we're not here to talk about news, and I'm sure by the time your listeners hear this, so much other stuff will have happened. But obviously, we're talking on Friday after Trump's tariff announcements. There's a big market regime shift, macroeconomic shift. So how those other factors will start to perform in that new climate, who knows? But it might see kind of smart beta return to interest, I think.
And how do you think the ETF industry in the UK will evolve over the next 5 years?
Sure. I think the key thing will be the entry of what we call kind of traditional fund houses into the ETF space. I think a lot of traditional fund houses have been reluctant to enter the ETF space because they've seen it as an area where basically you're competing with BlackRock, Vanguard on scale and price, right? So why would I want to enter the ETF market and create an ETF which is going to have to, compete with Vanguard, BlackRock for, can I charge 3 basis points for this S&P 500 tracker? Will that get the money in when, the other competitors are charging 5 or 4? So that's kind of kept kind of fund houses away from the ETF world. They said, what's the point of that? It's not the economics. It's such an uphill battle to kind of gain a foothold in it. But what we're seeing now is this growing awareness around active and other differentiated products where your USP isn't cost, which is a function of scale. Instead, it's your own IP and your potential or kind of past outperformance, which is the driver of that interest. So that's why I think you'll see a lot of more traditional fund houses come into the ETF world. At the same time, a lot of kind of traditional fund houses, they want to set up an ETF that's creating a whole new section of the business. But now you have, like with HANetf, kind of these white labelers. So if you are Jupiter, Guinness, you don't have to go and hire a whole ETF team, set up a new section of the business to focus on ETFs themselves, Instead, you can go to a white labeler like HANetf and then essentially we'll create that product for you. You'll have your branding, your IP, and then if they want HANetf distribution, a mix of it, or they can do their own distribution. So I think that kind of ease of access to the market has been one of the key drivers of more fund managers and asset managers in the US coming to the ETF market, and that is kind of a turnkey solution rather than have to set up your own business itself. So I think that will be a major feature, is that when your listeners who obviously on their II platform right now, obviously if they go and look at a lot of the kind of fund houses, they might see there's an investment trust version and there's an open-end version, and they have a choice between the two, whatever they wish, right? I think increasingly they'll start to see the third arm of that distribution, which would be an ETF. So they'll have a choice: do I want the ETF version, the trust version, the OIC version?
And finally, if consumers have that option, why should they choose the active ETF? Could we have 2 or 3 reasons?
Well, we're neutral on active versus passive. That varies on, which asset class, whichever approach. So I think with an active ETF, it's less why I want an active ETF over a passive ETF. I think you're trying to achieve different things there. In your portfolio, you have a different perception of markets. You're trying to access different areas of the market, etc. But instead, our view is why you should use an ETF for your active exposure over an OIC, or why you should use an ETF for your passive exposure over a traditional index fund. And that comes down to the key reasons: is you get that daily pricing, so not daily pricing, intraday pricing. You pay the price you see on the screen when you click that transact button on II. And at the same time, that fairer cost structure. There is some tax benefit to owning an Irish domiciled ETF if they own US stocks, which pay dividends. You get better tax treatment on those US dividends if it's an Irish domiciled ETF than if it wasn't. So there's also that argument. At the same time, I think you'll see a lot of the more innovative new strategies come via ETFs increasingly, like we've seen in the US. And then at the same time, the transparency. So this is slightly changing, but right now, your ETF has to publish its entire daily holdings. It's not the case with a trust or an OIC. In the US, they've changed it, and since 2019, that ETFs don't have to publish their daily holdings. But what we've seen is basically 90% of money in active ETFs is going to those fully transparent ETFs still, even when they have the option not to. They can have their semi-transparent, so not disclose their holdings daily. The 2 key regulators for ETFs in Europe, so in Luxembourg and in Ireland, where most ETFs are domiciled, are loosening the rules on this, and they are going to allow not full transparency. But I think, like in the US, most ETFs will still have that full transparency. So I think that's a benefit to investors too. They can pull up you can go on the ETF issuer's website and you can see exactly every day what those holdings are in full, not just the top 10. And this kind of one kind of example of this would be if you go back to say February 2022, after Ukraine was invaded by Russia, a lot of investors wanted to know, did they have any Russian exposure in their portfolios, right? Now with an ETF, you can immediately see that. You can see, okay, there's this Russian stock, or there's no Russian stocks. With a mutual fund, you're not going to be able to see that immediately, right? So that transparency, I think, is quite valued by investors, which is why, even though that transparency won't be required in the future in Europe for ETFs, I think it will still be the default way ETFs are structured.
My thanks to Tom, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave us a rating or review in your podcast app too. You can join the conversation, ask questions, and tell us what you'd like us to talk about via email on otm@ii.co.uk. In the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.